In today's video, I'm going to be sharing with you my 6 steps to day trading success. My name is Luke Burton. I've been trading the Forex markets for 11 years. So let's get into today's video. It's completely unsustainable for someone who is new to trading, or even someone who has been in trading for years, to focus on so many pairs and actually understand the flow of all of those pairs simultaneously and be able to execute their trading strategy perfectly. The reason most traders focus on so many pairs is number 1, to diversify, and number 2, because they believe there's not enough opportunity on just a single pair. Number 1, you do not need to care about diversifying until you have enough capital to actually diversify. And number 2, for perspective, imagine you're trading 1 million and your risk to rewards are 1 to 4. You can possibly hit 2 to 3 winners a month, making a possible 80 to 120k, or 100k, which is way more realistic with prop firms around, making 8 to 12k a month. Will your goal be to get as many trades as possible, or to make sure that you perfectly execute your system to guarantee that you catch those winning trades? It's a hell of a lot easier to focus on a single pair and maintain flow state, so do what is sustainable long term. So this is my step number 1 for success in day trading. Going from a list that looks something like this with between 6 to 20 pairs to a list that looks something like this with just a single pair or 2 pairs. And yes, you're going to have to develop patience, but you have to do that anyway. The more experience that you get, the more patient that you'll naturally become. Patience is a core concept for any successful trader, and the idea is that you don't miss anything on your pair so that you can execute your system perfectly and never miss a trade. A missed trade is a trading error in your system. It messes with your probabilities. I would not have stuck to one currency pair for the last 5 years if it didn't work. When you want to see if someone's process works, see how often they deviate from their process. Especially here on YouTube, you have people showing you new strategies every single week. Normally just for entertainment, we have kept the same concepts since video 1 because they work. And the main benefits of focusing on just a single pair is the intuition of that pair. Imagine knowing someone for the last 5 years. You know everything about them. You know their behavior habits. You know how they move. You know how they walk, how they talk. That's essentially exactly the same when you focus on one currency pair. You can understand the moves before they happen because you gain the intuition. And this will increase your chances to gain consistency when you focus on one thing at a time and you focus on executing that one thing perfectly. Timing is one of the most important concepts in the market. We use timing in day trading as our advantage to increase the probability of our setups playing out, and this is why. I recommend you focus on one of 2 trading sessions. Frankfurt or London session, which starts at 7 AM and goes to 10 AM UK time, or New York session, which is 12 PM to 4 PM UK time. Any time within that session. You can also use this indicator up here, it's called Forex Sessions as well, and add the timings in to London or New York session. And then you can also come down here into the bottom right of your chart and select London. These are the most liquid trading sessions, and in general they follow one clear direction for the time window, which means we have the opportunity to capture a big move nearly every day. We want to trade when there is volume in the market because volume means movement, and that movement can be tracked over time and optimized for our take profit. So let me show you an example here. So if we just go back on 2 weeks for Euro USD, here, this is the last 2 weeks, the start of it. And what we want to do in New York session, which is always the second session of the day, I'll just put the session breaks on here. We want to see how far price has moved within our session. So if we take the session low all the way up until the high of that session, we can see that price has moved 90 pips. If we look at this session, we can see that price has moved 34 pips, so on and so on, right? We can continue to do this, 46 pips. We go on to the next day, 57 pips. Missed the Monday as well there, which is also 122 pips. And then we'll continue on to the next one. Here from the high all the way down to the low. Obviously price has moved further than this as well, but 55 pips. We can see this session didn't move much at all, 27 pips. This session here, 45 pips. This session here, we moved 71 pips. And then the Friday during New York session, we moved here 73 pips. So if you was to do this and you was to go back far enough to understand all the volume changes in the market as well, you can utilize this information for your take profit. So if your stop loss is 10 pips, for example, and you see that most sessions are moving over 40 pips, then you could potentially squeeze out a 1 to 3 or a 1 to 4 risk to reward utilizing the information of the sessions and your trading window. If your stop loss is 20 pips and it's a 40 pip session, then typically you're going to be aiming for that 1 to 1.5 or 1 to 2 risk to reward. So it depends on your stop loss size. If your stop loss is 5 pips, obviously then you could aim for something like a 1 to 6 or a 1 to 8. And it's a mechanical way of trading that can also give you a fixed stop loss. And it's very consistent. So if you see that it's sustainable over years, which you can go back and test on the 15-minute chart, you have a take profit that will never change and that can always be optimized based on how the market is actually moving during your timing window. And to be good at trading, you only need to be good during your specific time window on your specific day with a specific setup. Timing allows you to focus on performing and improving that performance over time during your trading window. If you do the same things at the same times, you'll start to notice patterns in your execution and behaviors, and you can track those and improve them over time and experience. This is one of the keys to your personal development and trading success. We have to perform consistently to gain consistent results. So this is just one of the things that you can do during the trading session to maximize your potential return during your timing window. And making money isn't about trading all day long. It's about being the best at your specific time with your specific setup on your specific pair. Trading well only matters in your session. You can see we could also do this for London session as well to see how far prices moved during London session. Here we can see during London session, we only moved 20 pips, but we continued that direction for the rest of the day. The high to low on this day was 45 pips. Next day we can see here 57 pips. Here we can see between the low and the high, we moved 30 pips. Obviously, some days are going to change their direction. Some days are going to continue the direction in New York. Here we got 67. This day, all the way to the high, we got 8. Here, price didn't move much in the session. We only got 25 pips. Here, price moved 49 pips. Here we can see price moved 26 pips. Between this high and this low here, we moved 47 pips and so on, right? We can start to see, depending on your session, you just want to measure the low to the high of the session. And then you want to be thinking about take profit and where you normally get involved. If you normally get involved at the low of the session, or you normally take a continuation after the low, then try and think about what's most likely to hit take profit. So if you was to get in further away from the low and you want to be looking to take profit, is it a 40 pip take profit? Is it a 30 pip take profit? Go back and see what's most sustainable, especially over the volume changes in the market, because right now the volume is very high in the market. There will be times where price will only move 20 to 30 pips in the session. So you want to think about sustainability when you're thinking about creating your trading system. But this is just focus on timing. We can see outside of these timing windows in Asian session, which is this blue box on here, which if you just type in session boxes, it's the badger one in indicators. The majority of the time, Asian session doesn't move much and it's less predictable. We want to be trading when there's a lot of volume in the market because typically it's going to follow the same direction for that entire session. So if we get the direction correct in the session, we are more than likely going to take profit from that session. All of these things that we're going through here in this day trading success, these are all just increasing our probabilities of winning. These are giving us an edge in the market over the markets. So now you have your pair of choice. Now you need concepts to analyze the markets to understand direction and high probability trading locations, and you can apply on your entry strategy to these locations. So here is the NJT concepts. We use 4 main concepts to understand price. We have structure, which is number 1. That is a bearish trending market here, or we have a bullish trending market here as well. We have initiations, which will be very aggressive moves, very volatile moves in one direction to the upside or to the downside. And then we have sideways ranging markets here, or choppy markets, consolidation, however you want to see them. This is all representations of market structure. The next thing we use is trading location. Now it's important to understand the structure first, because then we can apply on our location tool to the structure and understand where we're taking our trades. And the location tool purely is just about understanding high probability locations and low probability locations on the charts. This will help us to make good decisions over time and put us on the side of probability. We don't want to be buying high in a trend. We don't want to be selling low in a trend. We want to be buying low and selling high in a trending market. When we're in a sideways ranging market, we want to be staying out of the middle of the range because this is the low probability locations. So we want to be staying away from making decisions in the middle of the range. And we want to be looking for those sell high or buy low locations inside a sideways ranging market because these are the highest probability locations on the chart. The next concept that we use in NJAT is RAMC. I'm sure you guys have heard of this before. If you're new to the channel, it is sideways range, initiation, mitigation, continuation. This is a bearish order flow pattern that helps us to read the intentions within the market for higher or lower prices. If we draw it on the other side, range, initiation, mitigation, continuation, this is a bullish order flow pattern in the market here as well. So what's happening when we see this pattern is we're seeing price contained sideways. What's happening in a sideways ranging market is orders are being created. When we see the initiation, that is the second phase of price. These are actually phases of the market that we will always go through. When people say that the market changes, it's only going to change for a more volatile market or a less volatile market. A less volatile market will be a higher time frame sideways ranging market. A more volatile market will be on a monthly, a weekly, a daily, and initiation market. These are the only phases that the market changes into. So once you understand this pattern here, the RAMC pattern, you will be able to understand every single volume change that happens in the market. I don't care what pair you trade or what market you trade, you will be able to understand every single change within the market. And this is all broken down in our advanced price action course. But once we break out of the sideways range, that shows the intention. We always pull back into that sideways range in the future. Now, of course, this pattern looks very different in many different ways. We could have a sideways range and initiation that gets left for the future, and then we pull back into that range in the future like so, and we could have a price action that looks a lot like this as well. It's still exactly the same concept. It's just a different variation of the same pattern. It carries the same intention that when we come back into this point in the future, the mitigation phase, that's where we want to be playing the next big move that happens in the market, which is always that continuation phase into a previous high or into a previous low within the market. And the final concept that we use to analyze the markets and build our high probability trading ideas is always targets, right? Where is price targeting? We're always going to target swing highs and swing lows within the market. All we want to do is look for the previous sideways range that caused the initiation and then started to pull back. This is always going to be our swing point within the market. That is always going to be the next target following the intention. Now, utilizing these four concepts here, you can start to build and make great decisions within the markets and build high probability trading ideas and apply your entry strategies onto those trading ideas. So let's get into an example now. So here it is. This is the next part. This is how we're utilizing the concepts together that you can learn at Not Just a Trade to formulate high probability trading ideas that are repeatable and consistent and follow exactly the same process every single time. It's really important to follow concepts that give you a repeatable way to understand the markets and to build a high probability trading idea. So I'm going to show you how we use ours to understand direction and the best locations to buy or sell. So one of the things that we're going to be using is swing structure breaks. And as we can see here, this is a swing high that's been broken on this time frame here. That's given us our intention of higher prices. If we just zoom in now and we start to think about what price has done leading up to this point, we can very clearly see that prices overall in this sideways price action here before we eventually broke out and broke that swing structure there to the upside. So we know that this is a very large area within price that we're going to be looking at to take our trades from in the future. This is utilizing the RAMC concept. If you're not aware of the RAMC concept, this is how we build intention in the market. We can look for our points of interest inside the sideways range. So we want to be looking for fractal lows here, or we want to be looking for representations of sideways ranges. So here we have two, right? We have a move down, a pullback, we run below, and then we see a move to the upside. So this is one area between this high and this low in the future. This is a buy order that needs to be mitigated out from inside a sideways range. And then of course we have this second area here, which is a very obvious contained sideways range before we broke out here to the upside. So let's draw these two areas on. So now I'm just going to take you back as if it was actually in the moment. We also, that's sideways ranges that we can use to understand intention in the market. What else can we also use? That's an NJT concept. We can also use structure. We can very clearly see that we're in a bullish market structure here. We're getting higher highs and higher lows. If you're looking at this low here and saying, why haven't you picked that low? You need to watch our Trading Missing Pieces course. This is not a swing low within the market. This is the most recent swing low to swing high. And what that's now giving us is our A to B price range here. right? So we can understand high prices and low prices within this swing point in the market. Now, if we just zoom out and see where prices reacted from here as well, because this is all a part of understanding the story, we can see that there's a very clear sideways market here, followed by initiation here to the downside. Now, price is reacting from a sell order inside this sideways range here as well. I don't have to be so specific because we can already see prices reacted from this area. I'm just looking at a general buy to sell inside this sideways range. We can see that we got that reaction and we've seen some bearish intention in the market here to the downside. Now, what's going to govern whether we take buys or sells in this location? Because we have two intentions that are in the market. We have this sideways range and we also have the sideways range that price is reacting from in the past, where this could become that continuation phase to the downside. The most important thing is understanding the location. This is why we use this location tool, because we want to be buying low or selling high. As we can very clearly see, prices at low prices right now. So the only thing that we can do is play previous sideways ranges at a good price to the left. These concepts that we're trading now, call them supply and demand, call it the Wyckoff theory, whatever you want to call it. All we're doing is looking for previous buy orders in the market. And the most important thing is that we're following the big banks. We're following the big players. They move price. We follow them. We follow their orders in the market and we follow their intentions within the market as well. So the concepts that we use, things like trade-in location, that helps us to understand high probability and low probability locations on the charts. Of course, underneath the 50% is high probability. The edge is going to be the highest probability. And of course, we don't want to be buying high here in this bullish trend because this is low probability trading. And of course, if we buy too high, again, this is low probability trading. So in general, this location concept alone helps us to understand high probability and low probability locations on the chart. The previous sideways ranges allows us to understand where we're looking for our trades from the past data into the future. The structure allows us to understand the footprints left behind in the market from the big players. And then liquidity targets, which will always be previous swing highs or swing lows, which we have marked with these blue dots here, will always be the target following the intention in the market. So if this previous sideways range to the left reacts and follows through, this low will become the target. If this sideways range and initiation, mitigation, continuation follows through, this will always be the target here to the upside. This is how we're building our high probability trading ideas. They follow the exact same process every single time. Now it's purely about reading the price action into these points of mitigation, watching as price slows down within the session. And this is where we apply on our entry strategies into the market, which is step number 4. Now, step 4 is about developing a trading system with an edge, also known as entries, right? Your strategy, the way that you enter, exit, and manage your trades. These need to be your rules for each. The rules keep you disciplined to your system, and that is what gives you a statistical edge in the markets. So entry, have specific rules for execution. Will you enter at market, limit order? What do you need to see to execute? How will you manage your trade to break even? Will you even move it to break even and take profit? I suggest you use your take profit based on the session moves that we went through in step 2, so that you don't have to worry about the execution. The execution part should be very easy. You shouldn't have to do any thinking in the execution. All of the thinking is being done in building the high probability trading idea, understanding the location that you want to be taking your trade from. Now, either find a strategy that works for you, an entry strategy, buy it from someone else so you don't have to spend so much time figuring it out for yourself, or spend the time and just develop it on your own if you can't afford to buy it from someone else. My strategy I've built over the last 3.5 years on the 15-minute, and I know everything about my strategy. I know all the different volume changes. I've seen the changes. I've been through the changes in the live markets, and I've tested all of the volumes. I've created the most sustainable way to trade my system so that I never have to change the main parts of my system. I'm not going to give you my trading rules. You have to pay for those. And for anyone who gets their back up about paying for something, that's going to save you a massive amount of time. Just know I spent 6 years of my trading journey paying every single month for mentorship when I was earning minimum wage. I prioritized my trading. I spent thousands to invest into myself and my goals. It makes me laugh when people out here complain about others selling mentorships. You have to pay to play. If you do have a problem with that, then don't pay and stay in the same position year after year. People that want to progress and are serious about their goals pay for the information. I did. I spent 6 years of my journey paying for trading mentorships, spent thousands for education, and you've got to ask yourself if you're happy with where you are in life right now. If not, learn more, invest in yourself, and make the changes. Our mentorship is an investment into yourself, and our strategy and view on the markets works. Otherwise, we wouldn't have hundreds of testimonials of traders gaining success with our stuff. So I utilize the 15-minute for my entries, and I'm utilizing, of course, the sessions because we know that there's a high volume in the session. So all I'm doing is looking for my entry at these points of mitigation and for it to line up with my session, and then I can get involved in continuations to the upside. I, in general, just play the direction of the market with a fixed stop loss at 10 pips, and I always look for 1 to 4 risk to rewards. The reason I look for a 1 to 4 is so that I don't have to worry about losing trades. Because if I lose 1 or 2 trades and I win 1 trade, I'm always going to end up as a net winner and in profit. But we can see here, this is a trade that I did actually take. The reason I took this is obviously it's at a previous mitigation. We have equal highs here that can become a target following that bullish intention in the market. And I saw my entry set up here as well. So like I said, my execution is execute with a 10 pip stop loss, and I play the overall direction. The direction's already been set from this previous sideways range and initiation. I'm just playing my entry at this point of mitigation and utilizing the candles as confirmation, so I don't have to do any work. I just have to identify, recognize, execute, and let the market do its thing. My management, I always move to break even at 15 pips, and then I just let the trade do its thing. So as we can see here, price ends up moving into 15 pips here, so I moved to break even, and then this trade ended up pushing back and taking me out for break even, right? This is just a part of the game. Flawless execution of my trade, which is always the most important, and we move on to the next entry setup. The next day here to the downside, this was a news day that happened at 7 o'clock. So for me, I don't bother trading news days at 7 o'clock. That's a part of my strategy. So we'll just play it forward to the next trading day. Okay, so we're into the next trading day now. What is something that we can automatically notice? Equal highs here, equal highs here. We are at the edge. If we just zoom out and look at our previous sideways range, this is the lowest price in this A to current B swing within the market, which is up here. This is really good buy low opportunities to play continuations to the upside with liquidity targets here to the upside as well. And both of these liquidity areas are at a low price relative to the location tool. This is really good opportunities to play buy continuations. And the trade idea is already built, right? So all I need to do is see my setup in the session, and I'm playing that overall direction within the market. So here I get my setup again at the start of the session. So all I'm doing is looking to get involved in the market with a 10 pip stop loss, and obviously targeting a 1 to 4 as always. Let's play this forward, and obviously we can see we got that explosion there to the upside, and we got that continuation, and we took out all the liquidity and moved back into the 50% area. So like I said, this is why I use high risk to rewards as well within my strategy, because I don't care about losing trades. I don't have any psychology issues with losing trades or taking break evens, because when I win, I'm always ending up in a net profit. And that's really important when you're building any strategy, because it massively helps with your psychology of execution as well. Now, step number 5, I hear this all the time. That entry was cherry picked. And yeah, no shit. That's exactly what having a strategy is all about. Not every day you're going to get an entry. Not every day you're going to get into the move. But if you can learn to sit out of the market when you don't get a setup and you have great risk to rewards, you'll only need around 3 to 5 winners a month to make amazing percentage gains every single month. I'm currently creating an execution psychology course. On the screen right now is all of the videos I am making so that you can learn step by step how to execute a trading edge perfectly. And this is the key to success of any strategy. Remaining in emotional control is a massive asset in your trading. Always choose control over the gamble. And those days where you can sit out and you don't get your setup will pay for those days that you do get a setup. Trading is 99% patience, 1% execution. So learn to develop your patience. That urge to want to be in the market, you have to talk yourself out of it. See the results of constantly jumping in and ask yourself if those are the results that you actually want. Patience is not wanting anything from the market. It's accepting that the market is going to give you what it gives you for that month. You can't force anything out of the market. I know it's hard because our minds are geared to thinking about trading as wanting something or understanding that we have to put in work to get something. But the work that you're going to be putting in is staying out of the market when you don't get your setup and flawlessly executing your setup when you do get your setup. That is going to give you the best opportunity to make profit. And mentally, that's what's going to help you to remain in control. So be looking out for that psychology course. I'm going to put everything into that course, everything I know and understand about execution, to give you guys the absolute best opportunity to make profit in the market. I know firsthand how difficult trading execution is. It is the most hardest thing for people to do. So I've put it into a step-by-step process that you can actually rehearse ahead of time to make it a lot easier for you to trade successfully. This next part here is something that you have to spend a long time doing, but this is exactly the steps to thinking in probabilities. Now, thinking in probabilities is probably one of the hardest things to do because you need to rewire your thinking, but this is the process that helps you, the 10 series. It is focusing on your trades, not as an individual trade outcome, but actually looking at your trades as a series of 10 trades at a time. Your goal is to flawlessly execute your rules for 10 trades at a time and see the results of those 10 trades. We never know the sequence to wins and losses. We could start off by having 2 or 3 losses in a row and then the rest of our trades being winners. We could also start off with having a losing streak of 5 losses and the next 3 trades end up being winners, and because of the risk to reward, that means that we actually make profit on that series. You never ever know the sequence of your wins and losses. This is what trading is all about, is probabilities. That's what having an edge is about. Over time, our edge is something that wins. So just look at this sequence here. This is a random sequence. You could start off by getting a win, break even, loss, break even, loss, loss. And at this point here, you could look at your past trades and say, well, I've only had 1 winner in the last 6 trades. And you could start to judge yourself. You could start to change something about your system, especially if this is over a span of, let's say, 2 to 3 weeks. And you could start to look at yourself and start to talk yourself and talk down to yourself when you start to see these results. Now, if that causes you to change something within your system, you've now changed the outcome of the next 4 trades, which means you've changed the sequence. So it's really important that when you trade and you think in probabilities, that you don't look at these individual trades here, but you think about flawlessly executing one of these trades at a time, and you wait until you finish the series to see the results of the trades. Because your next set of trades could look like 2 winners, 1 loss and a break even, which turns this series into a profitable series. And this is trading, right? This is exactly what it is about. So many traders can't understand probabilities, and they can't understand the fact that they could go on losing streaks within this 10 series and still end up as a profitable trader. So focusing on your 10 series and constantly redirecting your mind into flawless execution of your system is the only way to win in trading. I know right now the industry makes it seem like everyone is winning every single day. This is not the reality of trading. The reality of trading is you do not need to win every single day. You do not need to win every single trade. However, you need to maintain emotional control, and that is how you become a winner over time and over enough of your edges playing out in your favor. Focus on having positive risk to rewards, which also helps with your psychology, and take my psychology course. That is going to be the absolute best thing that you can do to understand trading psychology. I am not going to hold back in that course. You are going to have step-by-step on exactly how to change yourself, following my exact process that I use as well. Thank you all for watching. I hope you all enjoyed this video. Make sure you leave us a like and a comment if you did enjoy. Make sure you check out our website, notjustatrade.com. We've got a brand new website out there as well. Check out our testimonials page if you want to see other traders that are already in the community that are getting results. I'll leave those links in the description of this video. If you want to speak to me and Chucks, or you had any questions, make sure you use the chat feature on our website. That is us. That's not a bot that's answering those questions. Thank you all for watching. I hope you learned something from this video, and I'll catch you on the next one.